Welcome in. You know, earnings season can feel like a total guessing game, right? It's a nail-biter for any investor, but what if I told you the market was already leaving little breadcrumbs, clues about its next big move? Today, we're going to learn how to read those signals. Let's get into it. The famous physicist Niels Bohr really hit the nail on the head when he said, "Prediction is very difficult, especially about the future." And that feels especially true in the world of finance, where one little earnings report can send a stock to the moon or into a nosedive. But here's the secret. The little trick up our sleeve, while nobody has a crystal ball, the market leaves a trail. It's constantly whispering its plans. You just need to know how to listen. The earnings guessing game. We've all been there. Every quarter, investors are just holding their breath, asking the same exact questions. Are they going to beat expectations, or are they going to miss? It creates this high-stakes casino where fortunes can be made or, lost in an instant. Yeah, this is when things get really wild. And that extreme volatility is exactly why earnings are so risky. But here's the flip side. That very same chaos creates incredible opportunities. It attracts all the big-time traders who use some really complex tools to place their bets, and, well, it's those bets that we are going to learn how to decode. So, how are we going to do it? We're going to look at options contracts. But not for betting, not for trading. Nope, we're going to use them as a listening device, kind of like a stethoscope on the heart of the market, to hear what it's really anticipating. And our playbook is actually pretty simple. It's just 3 steps. First, we're going to find where the unusual activity is hiding. Second, we'll figure out how big of a move the market is bracing for. And finally, we'll try to get a sense of its direction. Okay, let's dive right into step 1. I want you to think of yourself as a financial detective. Your whole job is to sift through all the noise, all the chatter, and find the real signals, the trades that actually matter. Now, this search has 2 parts. First, you're scanning for a big spike in trading volume, especially for options that are about to expire. But, and this is important, volume by itself doesn't tell the whole story. The real secret sauce is comparing it to something called open interest. So, what's the difference? Well, think of it this way. Open interest is the total number of bets that were already on the table before the casino opened today. Volume is all the new bets being placed right now. So when today's volume is way higher than the open interest, that's a huge flashing sign that people are aggressively opening brand new positions. Something is up. Take a look at this. This is a real-world example from the company Baidu. You can see the trading volume for these call options is just blowing past the open interest. This isn't just random noise, folks. This is a crystal-clear signal that traders are piling in, making some really aggressive bullish bets right before an earnings report. This is our first clue. Okay, so we've found a signal. We know something might be about to happen. But the next logical question is, how big? I mean, is the market expecting a little tremor or a massive earthquake? To figure this out, we use a really cool strategy called a straddle. A straddle is basically a pure bet on chaos. By buying both a call and a put, a trader is saying, I don't care if the stock goes up or down, I just need it to move a lot. And the price they're willing to pay for that bet tells us exactly how big of a move they're expecting. Let's make this really concrete with a quick case study on Google. We can actually calculate the market's expected move, right down to a percentage point. It's pretty cool. So, first up, we take the price of an at-the-money call option. In this case, it was $1,200 for one contract. Next, we add the price of the matching at-the-money put option, which here is $1,670. And boom, that gives us a total cost for the straddle of $2,870. This number, this is the key to the whole thing. Now, here's the magic. We take that total straddle cost, we divide it by the stock's current price, and there it is. The options market is basically telling us, loud and clear, that it is pricing in about a 5% move for Google after its earnings report, either up or down. All right, we've found the clue. We've measured the size of the expected earthquake. So now we come to the final and, let's be honest, the trickiest piece of the puzzle. Which way is it headed? Up or down? For this, we have to look at how the trades are happening. Think about it. If buyers are so eager to get in that they're paying the higher ask price, well, that's bullish pressure. On the other hand, if sellers are so desperate to get out that they're taking the lower bid price, that's bearish. It tells you who's being more aggressive. But it's also about context, right? You have to look for the deeper strategies at play. For instance, a big surge in people selling call options might not just be a simple bet that the stock will fall. It could be big, long-term investors just hedging their portfolios against a potential drop, which is a much more subtle, but still pretty bearish signal.
So there you have it. Let's pull all three of these steps together into a powerful, repeatable playbook that you can use to listen in on the market before it makes its next big move.
So remember, first, you're the detective, looking for that unusual volume that's crushing the open interest. Second, you become a seismologist, using the straddle price to measure the size of the expected move. And third, you act as a psychologist, analyzing the bid versus ask pressure to predict the likely direction.
Now look, is this a perfect crystal ball? Of course not. It's part art and part science. You got to think of it as just increasing your odds, not guaranteeing a win. But it is an incredibly valuable tool that can turn all that market noise into a much, much clearer signal.
At the end of the day, the market is always talking. It's constantly leaving clues about its deepest hopes and its greatest fears. The only question left is, are you ready to stop guessing and actually start listening?